Good morning, ma'am. I'm Sopanika from 3rd BCom C. My topic for today is Introduction to Financial Risk Management. Let us see the introduction to financial risk management. Financial risk management is the process of understanding and managing the financial risk that the business might be facing either now or in the future. In every business, there will be both profits and losses. Always, a business cannot earn only profits or only losses. So, profits and losses occur at a period of time. So, financial risk management is a process of knowing the financial risk in the business and know how to overcome the risk. The key to any financial risk management strategy is a plan of action. The key to any financial risk management is to plan and to bring the plan into action, that is, to execute the plan in the form of action. Taking up the risk will enable the staff to know how to manage the risk and know their company's financial weakness. So, when the staff of a company takes risk in order to earn profits, he will know how to manage the risk and will be able to understand the company's weakness. Thank you, ma'am.
Morning, ma'am. I'm Suman. My topic is about introduction about interest rate risk. It is the risk that the investment already held will lose the market value if the new investments with a higher interest rate risk enters the market. Interest rate risk affects the value of bonds more directly than stocks, and it is a major risk to all bond holders as the interest rate rises. Interest rate risk is more relevant to fixed income securities, whereby a potential increase in market interest rate is a risk to the value of fixed income securities, where market increase rate increases price on previously issued fixed income securities as traded in the market deadline. Since potential investors are now more to buy new securities that offers higher rates, only by having lower selling price can past securities with lower rates become competitive with securities issued after market interest rate have turned higher. For an example, Mr. A buys 30-year bond of 10,000 rupees with a fixed rate of 3%. He can hold this bond for 30 years to earn 300 per year and collect 10,000 after 30 years. When the bond matures, alternatively, he can sell this bond for prevailing market price in the secondary bond market. Interest rate risk is the risk that should be sold before 30 years. The price he will get should be assumed for 1 year. The market interest rate rises and the new bonds come in the market that pays 4% of interest or 400 per.
Hello everyone, I'm Shweta S. I'll be explaining about several reasons why interest rates differ in different markets and market segments. There are 8 reasons: risk, the need to make a profit on relending, the size of the loan, different types of financial asset, the duration of the lending, expectation theory, market segmentation theory, and government policy. First point, gross interest rate differ owing to the differences in the risk and inconvenience involved, cost of maintaining accounts of borrowers, and trouble associated with the business of lending, etc. The greater the risk and inconvenience, the higher is the rate of interest. When there is risk and inconvenience involved, there will be differences in interest rate. And also, here, the cost of maintaining accounts of borrowers are associated with the business. In this case, the rate of interest will differ because if there is high rate of interest, the risk and inconvenience will also be greater. Second point, the need to make a profit on relending. Banks and other lenders are in business to make money. Financial institutions pay a low interest rate on depositor accounts such as savings and money market accounts. Then use that money to lend money to borrowers at a higher interest rate in the form of loans and credit cards. The financial institution pay low interest rate on depositors' accounts. Then they use same money to lend to borrowers at a higher interest rate in the form of loans and credit. This is one of the reasons where interest rates differ. Moving to the next slide. The size of the loan. Generally, longer the duration of loans, the higher will be the interest rate. Loan sanctioned for a long period usually carries high interest rate since money or capital is locked for a long time. A short period loan carries a low interest rate. The rate of interest will be high because the duration of loan is for longer period, and loan sanctioned for long period usually carries high interest rate since because money is locked for a long time. In the same way, for short period loan, it carries low interest rate which differ in different markets and market segments. Fourth point, different types of financial asset. Interest rate varies with the nature of securities offered by the borrowers. Loans against the security of gold or government bonds carry less interest since these securities can easily be converted into cash by the lenders. But loans are also sanctioned by giving securities of immovable properties like land and house. Rate of interest against those securities will tend to be high since they are not easily converted into cash. Securities like gold, government bonds carries less interest because these can be easily converted into cash. But properties like land and house tend to be high rate since they cannot be easily converted into cash. And yes, because of these changes in financial assets, the interest rate differ in different markets. Hope you all understood the first four. I hope you all understood the first 4 points which I have explained you now. The next 4 reasons why interest rate differ in different markets and market segments will be explained by Muskan. Thank you.
Hi, this is Saida Muskan Alia. Topic: continuation of hedging techniques, interest rate. The duration of lending, expectation theory, market segment theory, government policy. The duration of lending. A term is a duration that has been lended as loan until it's been paid big, such as 60 months maybe for an auto or 30 years of mortgage. That is known as big duration, but the lender has to pay more interest overall on a long term. Expectation theory. It is a prediction of long term interest that is to be in the future or current long term interest rate. But here the theory suggests that an investor earns the same investment that he can earn in 2 consecutive over 1 year. Market segmentation theory. Market segmentation theory is a different phase of long term and short term interest, where long term and short term cannot be related to each other. Both the prevailing interest rate of short term and long term should be viewed separately, such as items in different markets for debt securities. Government policy. Monetary policy is a policy adopted by the monetary authority for a nation to control either the interest rate payable for very short term borrowing, like borrowing by banks from each other to meet their short term needs or the money supply, often as attempt to reduce inflation or interest rate to ensure price. Thank you.
My name is Sayeda Sarwat Akhtar, and my topic is the general level of interest rates is affected by several factors: need for real return, inflation, uncertainty about the future rates of inflation. Need for real return. Real return is what is earned on an investment after accounting for taxes and inflation. Real returns are lower than nominal returns, which do not subtract taxes and inflation. Example of real return: in the inflation rate is currently 3% per year, the real return on your savings is only 2%. In other words, even though the nominal rate of return on your savings is 5%, the real rate of return is only 2%, which means the real value of your savings increased by only 2% in a year. Inflation. Inflation is the decline of purchasing power of a given currency over time. A quantitative estimate of the rate at which the decline in purchasing power occurs can be reflected in the increase of an average price level of basket of selected goods and services in an economy over some period of time. Inflation can occur when prices rise due to increase in production cost, such as raw materials and wages, a surge in demand of product cause inflation as consumers are willing to pay more for the product. Uncertainty about the future rates of inflation. Uncertainty about the inflation can affect the economy extend through three channels. If inflation is uncertain, the return on nominal long-term debt will be riskier. As a, as a result, investors will require higher expected return, which imply higher long-term interest rates.
Good morning, ma'am. Myself Tarannum. And our topic is the general level of interest rates is affected by several factors. I will be explaining from the fourth point, that is liquidity preference of investors and the demand of borrowing. Liquidity preference theory refers to investors should demand a high interest rate or premium on securities with long-term maturities that carry greater risk. This means the securities which carry greater risk, that the investor should demand a high interest rate or premium, because investors prefer cash or other highly liquid holdings. Fifth point is balance of payments. The balance of payments, also known as balance of international payments, summarizes all the transactions that a country includes. Government body inside the country and the government body outside the country. This transaction consists of imports and exports of goods and services and the capital, as well as transfer payments such as foreign aid and remittance. Sixth point is monetary policy. Monetary policy, it is a policy adopted by the monetary authority of a nation to control either the interest rate payable for every short-term borrowings. For every short-term borrowings means the borrowings made by the banks from each other to meet their short-term needs or the money supply. Monetary policy is adopted to attempt or to reduce the inflation rate or the interest rate. Next point is, that is seventh point, interest rates abroad. High interest in a country increase the value of that country's currency relative to the nations offering low interest rates. Whenever there is a high interest, automatically the country's currency increase with offering the low interest. However, such simple straight line calculation rarely exists in foreign exchange. Thank you.
Tasme Ansari, and my today's topic is interest interest rate risk management. Interest rate risk can be managed using internal hedging in the form of matching and smoothing forward rate agreements. Under matching and smoothing are two methods of internal hedging used to manage interest rate risk. To manage interest rate risks, there are two methods called matching and smoothing. Matching is where liabilities and assets with a common interest are matched. In under this matching process, the liabilities and the assets are matched to the rate of risk is matched. Under smoothing, where a company keeps a balance between its fixed and floating rate of borrowing. Under this method, the company keeps balance between the floating rate of borrowing and fixed rate of borrowing. Next, forward rate agreements. These agreements effectively allow a business to borrow or deposit fund as though it had agreed a rate which will apply for a period of a time. In the under forward rate agreement, this allows a business to borrow or deposit funds as it was agreed at a rate which will apply for a certain period of time. The period could be, for example, start in 3 months time and last for 9 months after that. Such an FRA would be termed 3 to 12 months agreement because it starts in 3 months and ends after 12 months. Note that both parts of the timing starts from the current time. Okay, under this, for example, if we take a loan and at the month of 3 and it will end after the 12 months, after the 12 months of the after the 12 months of the loan, such as this FRA will be termed as 3 to 12 agreement. Next, the loan or deposits can be with one of financial institute and the FRA can be with an entirely different one, but the net outcome should provide business with a target. The loan or deposit can be with one financial institute and the FRA can be entirely different. FRA you can be entirely different from the from one to another financial institute, but the net outcome should provide the target of the business profit of the business. Fixed rate of interest, this is achieved by compensating amounts either being paid to or received from the supplier of FRA. The FRA income is received by compensating the amount being paid to or received from the supplier of the FRA, depending upon the how interest rate moves on. Interest rates can be increased also, it can be decreased also. For example, we'll have an example about this. Example, Neuro company flow forecast shows that it will have to borrow $2 million from Goodfellow Bank in 4 months. Time for a period of 3 months. The company fear that by the time the loan is taken out, interest will have risen. The current rate is 5%. The risk can be minimized by entering into 4 to 7 months FRA at 5%. Okay, in this, Neuro company should borrow a loan from $2 million loan from Goodfellow Bank for in 4 months. In 4 months they have to borrow. The time period for 3 months, the company has a fear that at the time when the loan closes, the rate of interest might be rise. There must be rise in the rate of interest. The current rate of interest is 5%. To minimize that risk, they can enter into 4 to 7 months of FRA at 5% interest. Thank you, ma'am. Time for a period of 3 months. The company fear that by the time the loan is taken out, interest will have risen. The current rate is 5%. The risk can be minimized by entering into 4 to 7 months FRA at 5%. Okay, in this, Neuro company should borrow a loan from $2 million loan from Goodfellow Bank for in 4 months. In 4 months they have to borrow. The time period for
3 months, the company has a fear that at the time when the loan closes, the rate of interest might be rise. There must be rise in the rate of interest. The current rate of interest is 5%. To minimize that risk, they can enter into 4 to 7 months of FRA at 5% interest. Thank you, ma'am.
Good morning, ma'am. Myself, Triveni S. My presentation topic is Internal Rate Risk Management, Future Contracts, and Interest Rate Options. First and foremost, internal rate risk is nothing but it is a risk which is associated with rate fluctuations in assets. It is related to forward and future contracts, which helps in investors hedge interest rate risk. Hedge is nothing but it is an investment position intended to offset potential losses or gains that may be incurred by a companion investment. Internal rate risk is managed by two forms, which is future contracts and interest rate options. Future contracts is nothing but an agreement to buy or sell a debt instrument at a specified future date at a price that is fixed. The underlying security for interest rate future is either government bond or a treasury bill. Second point, interest rate options. It is financial derivatives that allows investors to hedge or speculate on the directional moves in interest rate. Thank you.
Good morning and a warm welcome. Myself Vaishnavi. And my presentation is on interest rate risk management. First and foremost, let's see what is interest rate risk management. That is nothing but the risk that arises when the absolute level of interest rate fluctuates, which may rise and fall irregularly in number or amount. If the risk which arises from unanticipated, which is not expected or predicted fluctuations in the interest rates due to the monetary policy measures undertaken by the central bank of a particular country. The yields offered on securities across all markets must get equalized in the long run by adjustment of market demand and the supply of the instrument. Hence, an increase in the interest rate would also cause a fall in the security price. It is also primarily associated with fixed income securities. Example for interest rate risk management. If an investor has invested some amount in a fixed rate and the bond at the prevailing price, he offers him a coupon rate of 5% and if thereafter interest rises to 6%, then the price of the bond would decline. This is because the bond is offering a rate of 5% while the market is offering a rate of return of 6%. So if the investor wants to sell this bond in the market, then the buyer would offer him a lesser amount for the bond as this bond is low yielding as compared to the market. By doing this, the new investor would try to earn the return similar to the market as the invested amount is less. Interest rate derivatives. The meaning of interest rate derivatives is an interest rate derivative is a financial contract whose value is based on some underlying interest rates or interest bearing asset. Under that first point, interest rate cap. A cap is nothing but which involves using interest rate options to set a maximum interest rate for borrowers, and if the actual interest rate is lower, then the option is allowed to lapse. Next point, interest rate floors. A floor involves using interest rate options to set a maximum interest rate for investors, wherein we saw in the interest rate cap there is set a maximum interest rate for the borrowers, but in interest rate floors it is set a maximum interest rate for investors. If the actual interest rate is higher, the investor will let the option lapse. Next point, interest rate collar. A collar involves using interest rate options to confine the interest paid or earned within a predetermined range. In this, the borrowers would buy a cap and sell a floor, thereafter offsetting the cost of buying a cap against the premium received by selling a floor, and here a depositor would buy a floor and sell a cap. Next point, interest rate swap. Interest rate swaps allows companies to exchange interest payments on an agreed national amount for an agreed period of time. Swaps may be used to hedge against adverse interest rate movements or to achieve a desired balance between fixed and variable rate debt. Interest rate swaps are arranged by a financial intermediary such as a bank. Thank you.
Hello everyone, this is Zeba Yassa. So my topic is traditional and basic approaches. Traditional approaches are the customs, beliefs or method that once have been existent for a long period of time. So basically this is something which has been functioning for a long period of time without any changes. So dealing with this for long existing time is called traditional approaches. Assets and liability management. This relates to the period or duration of which loans and deposits allows the issue raised are not conformed to variable rates arrangement. Because a company can face difficulties where amounts subject to fixed interest rate or earning mature at different times. So basically, this assets and liabilities management is the practice of managing financial risk that arises due to the mismatch between the assets and liabilities for the long-term investment and strategy in financial accounting. So this is the end of my topic. Thank you so much, guys.